Hi, welcome to Market Alert for Friday, the 27th of March 2020. So, Insanity stocks enter new bull market on day initial claims hit 3.3 million. Yeah, very, very strange day. You think with 3.3 million claiming unemployment benefit and status in the US, as you see here, a record of 3.28 million, and you can see the chart here. It's just vertical, but that's how the markets work. It's not about whether people are claiming benefit or not. And there was another reason as well. If we just scroll down in here into the item and just have a look at why, because I sat there wondering, why is this just keeping going and going and going, and it never stopped. But apparently there was quite a few banks to the tune of 850 billion sitting on the sidelines, but to meet the rules and regulations had to buy stocks. And you'll see it down here somewhere in a second. I can find it. Okay, found it now. But for the third day in a row, the cash market open in the US sparked another buying panic, as it seems the 850 billion buyer in the month-end rebalancing is in the market. So a lot of buyers had to rebalance the portfolios, while the month-end pension rebalance suddenly appeared in the last 10 minutes of trading, sending the S&P up 40 points in literally one trade, after it emerged that the market on closing balance was 7 billion. So this is why the market moved higher yesterday. It was, you can see there in the chart. So as it says here, and so after the furious rally of the past 3 days, and coupled with the last 10-minute market on close surge, the S&P is now back in a bull market, surging at over 20% from its Friday lows. You couldn't make this stuff up, could you? What's going on globally? 3 million claiming unemployment benefit in the US, and a few banks having to rebalance their portfolios to the tune of 850 billion sends the Dow to the upside. So here in the 5-minute chart, you've got this is the unemployment figures, which is ludicrous in and of itself, that the fact that they saw the market move higher. And this is not a small bar, it's just that it's compressed because of the other continuous buying. This is 361 points on bad news, and the market moves higher. So the manipulation continues at a great pace. As far as the Treasury is concerned, they're going to do whatever they can to still try and bring this market back. But how far can they bring it? That's the question. So then we see the market open, and it just continues. It's just relentless. And then as we get towards the end of the session, but just before we do that, let's just measure from this low to this high to get a ballpark figure. So there we've got a 1,700 point move in the Dow. And then if we come across here, you can see where the pensions came in at the end and bought. And just on that one bar alone is nearly 500 points just for this bar. Just to show you what's going on there. It's just insane. But overnight prices are sort of sideways to low. They've had a bit of a bounce at the moment, but it's interesting to look at the daily chart, because in yesterday's market alert I spoke about the 20-bar moving average being a resistance for this market, and currently it is. And then could we see prices move to the downside? Well, have they got any more tricks up their sleeve that they're going to throw at the market today to make this look like it's no big deal? Well, we'll have to wait and see. But we've certainly got the dead cat bouncing at the moment. There's no doubts about that. It's a question of how much can he bounce before we see the market move to the downside there. One thing that we could do here is, I don't know whether this will work or not, but let me just try this. Let me just change this to a 5-bar moving average and add it to the chart. Yeah, this will be an interesting one to see how quickly prices can close back below the 5-bar moving average there in the daily. So I'm going to save that because you can see there once it closed above, and then once it closed below, it then moved lower and didn't trade back or close back above until here. And it's something that I've used a lot in intraday trading to actually move the stop loss as well on trades, just to see how the market's holding at this fast moving average. But in the weekly, you wouldn't think there was a problem at all. I mean, you see this reversal this week, a massive reversal. Again, if we measure this from the low to the high, just to get a ballpark figure there, 4,600 points. Wow, in 1 week. And then in the monthly chart, you really wouldn't think there was a problem, because now we're back above the 21,597. But like I say, the bigger question is, how long can this last for? I mean, as the economic impact of the coronavirus sinks in and going forward, if 3 million are lost in 1 week, what's it going to be like next week? I think you're going to see a bit of a trend going on here going forward as the lockdown continues for most of the world and commerce shuts down. And like I said before, if people think that after this is all over, that everything's going to revert to normal, then you really are not thinking this through, because the financial system is broken. We're seeing trillions upon trillions printed. And if we go to here, if I can just find it, I think it's in here. Yeah, not that one. Got so many windows open at the moment to try and bring this to you. Yeah, the Fed balance sheet hits 5.5 trillion. This is an increase of 1.3 trillion in 2 weeks, 6% of GDP. When there's no commerce going on around the world, no trade, then and you're printing like this, it's just absolutely impossible to get back to what we had just a couple of weeks ago. Absolutely near on impossible. The other thing to keep in mind as well, I'm jumping around a bit here, but it's trying to remember there's so much going on at the moment. One thing is to be aware of is that ETX, and I would imagine that quite a few other spread betting companies are going to do this, they have suspended the rolling gold contract. However, they haven't stopped silver, but don't tell them. That one with the ratio, the gold-silver ratio, is a better one to trade than the gold contract anyway, as a holding position. But I suspect that we'll be getting an email next week to say that this one won't be available as well, and we have to trade the futures contract, which is a bit of a pain. They're saying it's due to a lack of liquidity. That's because the GLDs, or the owners of the GLDs, these are the ETFs of the gold markets. You only bought the paper, you didn't buy the physical, but you could convert the paper to the physical, and of course nobody's got the gold, which is why we're seeing a premium at the moment in the spot market against the futures market. So let's see again going forward how this one unfolds as well. What else have I got to tell you? Well, yeah, this is fascinating as well. In all of the 30 years that I've been trading, I've never seen this. We'll start off in a bit closer here. Now, the market went up yesterday, I don't know how many, what was it, 1,500 points or somewhere in that range. Seems to be the daily average now. We've gone from 150 points to 1,500. But what's interesting here, the implied volatility, and for those of you that are new to this, implied volatility is the sort of measure of risk in an options premium. And the options traders factor this into their pricing to work out what sort of risk they're going to have and how they should charge for this by passing it on and the cushion. It's a bit like insurance, really, with insurance companies. But I've never seen this before. Normally, the volatility increases when the market goes down and not up. And yet the market went up yesterday 1,500 points, and the volatility has actually created a new record high. I've never seen this before. And if we go back to the whole chart of where I've collected the data since 2006, been through all of these other corrections where we've seen a doubling of the implied volatility, where prices have moved lower in these shakeouts. This is unprecedented. Seems to be a word that's used an awful lot at the moment with what's going on, but this really is. I've never ever seen this. And not only that, but we're way beyond the 2008 now as well. I mean, this is really odd. So whether the options traders see that yesterday's move to the upside is simply one of not being sustainable, and they're going to move prices lower, and they're already factoring this in. Remains to be seen, but yeah, very, very interesting. They've not updated the bond yields of the 10-year, 3-month, and for the last day, or for yesterday, they managed to bring it up to date for the 24th, 25th now. I don't know why, but they're not. But nothing to talk about there, really. I mean, it remains a normal market. It's no longer inverted. And we can see here it's just a matter of time now before we get the blue box down here to show that recession that I predicted last year. Obviously, this has been accelerated and brought forward, and not only that, but also we've got a situation where it's not going to be a recession, but known as the Greatest Depression. Okay, that will do it for this one. It's a bit of a long one, but a lot to impart at the moment with what's going on. So, yeah, let's see what happens today as the market, whether it will hold at the 20-bar moving average in the daily chart. As ever, thanks for watching. See you in the next one.